There are just 4 trading days left this year, and James Dunigan expects that Santa Claus rally to continue right through New Year's Eve. He's managing executive of investments at PNC Asset Management Group. So, Jim, we end this year obviously on a very high note, but when you're this high up, it makes you wonder how much higher can stocks go in the new year?
Well, that's the question on investors' mind these days, Susie, as you said, but certainly Santa has delivered. Ended up the year with an update today, and we do believe that this Santa Claus rally, which will go through the first couple of days of January, will continue. We're on the backs of very strong economic data.
So what is your outlook for 2014 in terms of how much the major averages could go up? I mean, you're coming off of a really strong year, up 30% or so.
Well, as you say, we have benefited from the asset purchases of the Federal Reserve over the last couple of years, but particularly in 2013, we'll see almost a plus 30% year on the S&P if you include dividends. Not likely we'll see that in 2014. We're more in the single-digit range, something in the 8 to 12% range, depending on how earnings go. But it will be a positive year for equities, just not investors should not forecast what we've seen the last 12 months.
Well, there's been a lot of talk among market strategists about a correction or two coming up in the new year. Now, investors are always told you can't time the market, but I'm still going to ask you a question about that. If there is some kind of a correction, are investors better off waiting for that pullback to happen before they put any fresh money into the markets?
Well, if you look back at 2013, Susie, investors who tried that were not very successful. So all we got was a 6% correction. Now, on average, over the last 33 years, the intra-year decline is about 14%. So in all likelihood, we will see a decline in 2014 larger than the 6% we saw, probably something in the range of 10%, maybe to 15%. Hard to predict when that would be. So I would suggest investors not try to time that market, but understand what their plan is. If they're allocated to equities, underinvested in equities here, they put a plan in place early in the year to invest throughout the year. Over that time frame, they'll be mostly right. Not likely they'll get it all the way right by trying to time when that downturn will be.
All right, so we've got 4 trading days left for this year. Are there, you talk about an investor plan, portfolio plan. What should investors be doing? Is there anything they should do within this deadline time, or does it make a difference? Should they be buying things, selling stocks?
That's the question. And certainly with an up 30% year, not likely they have as many losses in their portfolio. But certainly the first thing you should do is take any losses so you can offset that against any gains that you have in your account. I would suggest probably not recognizing gains here in the last 4 days of the year. But investors should take this opportunity. If you've been fully allocated to stocks, you're now overweighted in your portfolio allocation. So I'd start to take the opportunity to rebalance your portfolio. Certainly opportunities in the developed countries, Europe, emerging markets. So to allocate away from U.S. stocks if you have benefited from this rally in this market. And then look at the risk in your fixed income portfolio. This will be a year we'll see negative returns in bond indexes. Look where your durations are, where your risk is, and try to de-risk some of your fixed income portfolio against what we would suggest is a rising rate environment in 2014.
A lot of important decisions you have to make. Thank you so much, Jim, for coming on the program, and happy holidays.
Thank you, Susie, and happy holidays to you.
Thank you so much. Jim Dunigan of PNC Asset Management Group.